Thank you for joining us today. I'm Lindsay Sechelle Rubenstein, and we hope that you are safe and healthy, quarantining with your family and not driving each other too crazy. Today, we are happy to have our founder and CIO, Bob Robotti, here with us to discuss a very pertinent topic, the frenzy at the intersection of COVID-19 and oil and energy. What does it all mean? Are there investment opportunities out there for us? Well, with approximately 40 years of investment experience and 15 years of boardroom experience, we hope to break it down for you, dispel some of the misconceptions, and discuss some of the prevalent trends and opportunities. So with that, let's get started. Bob, we're all living, as I was just describing, in this ever-evolving COVID-19 environment, something that we've never experienced before. With all the volatile headlines like negative oil prices, market highs, market lows, as an expert in the energy sector, how do you view the world today?
Thanks, Lindsay. So first off, as we all know, we're living through the novel coronavirus. And we think the name itself is great because it tells us how this is a time we've never seen before in our lifetimes. That makes me think back to 1973 and another situation that was a never seen before event, and that was gasoline rationing across the country. So how did that happen? What had been is, for decades, U.S. production had been declining, and the countries that eventually became OPEC were supplying our shortfall. At one point, there was a tipping point, and that is a war in the Middle East. OPEC, as a result, decided to flex that new supply muscle and instituted an oil embargo against the West. So here in the United States, we were forced to ration gasoline when it was available. So you had to check your license plate. Did you have an odd or an even number ending plate? That determined if you could get online to get gas. But even if you waited online, by the time you got to the pump, frequently it had run dry. So in that process, routine life became extreme and very unroutine. So what happened was an unexpected event was a catalyst for a permanent change. That permanent structural change, which actually had been building for years, was the West's growing dependence on oil supplies from OPEC. The tipping point brought about gasoline rationing and a tripling of prices at the pump. Today, we have the novel coronavirus. This time, it's a huge shock to the demand side of the equation. That's what happens when a mobile society is temporarily immobilized. Once again, you have volatile oil prices. This time, prices gap down dramatically. Now, when things like this, the important thing to ask yourself is, what's the transitory and what's the permanent? People do absolutely tend to focus on the temporary things, and you can't help it. But it's important to remember it's the permanent ones that really matter.
Well, thank you. And I think that touches on a broader topic, which is given the more temporary changes, how does one distinguish those between the more permanent and structural in nature, especially in this quickly evolving and confusing world?
We think a really important permanent change is the realization that much of U.S. onshore oil shale production is really uneconomic. We think the temporary change is the immobilization of society. And just today, as we don't have gasoline rationing, we think that our society will once again be mobile. Of course, it's understandable that people focus on the immediate and the transitory extremes of life. We understand that. But we caution against making decisions driven by those transitory effects. Instead, focusing on the long term is imperative, and that is also consistent with our long-term investment horizons.
Well, it's very interesting, and the view you're expressing on onshore shale has been one we've held for quite some time, and also one that has been viewed as quite contrarian by some others on Wall Street. So I guess please spend some time to explain, what do you mean by onshore being uneconomic, and what does that permanent change mean for the industry as a whole?
I really don't think you can overemphasize the importance of onshore oil shale. Right? The idea has come to be that the U.S. is oil independent. That we believe, myth really has become pervasive, but we think current events should dispel that. Specifically, that's the tout. America is oil independent. but not so fast. Someone forgot that oil production needs to be economic. It needs to generate cash returns to be sustained. That's not been the case to date. And therefore, we think that COVID-19 is actually the death knell for onshore oil shale without much higher prices, definitely over $50 a barrel and probably 60 for much of it to come back on, and for a sustained period of time to be able to draw capital back in. Our observation is that the advent and growth of onshore shale really has oversupplied the world oil markets twice in the last decade. So the first time it had been building consistently until the Saudis refused to hold prices up in November of 14, and that's caused a temporary decline. However, there was a flood of new capital from opportunistic distressed investors, private equity, and Wall Street generally that brought in capital, and with it, onshore production came roaring back in 2017 to grow at about 1 million barrels per day per year until, once again, the oil markets were oversupplied. An economic fact is that drilling consumes capital, and therefore, without generating capital, it can't be sustained. You actually saw that by the spring of 2019, approximately a year ago, we think the capital rug had been already pulled out from underneath onshore oil shale. Right, so pre-COVID-19, the onshore drilling rig count had been declining, and so it was down about 30% by January of 2020. Then, of course, you have the immobilization that exacerbates the decline. But as day follows night, production is declining, will decline, and will decline precipitously. You've already seen supplies going off, and that is accelerating. An important mitigating fact in the problem of onshore oil shale is that a lot of these wells deplete on an extremely fast pace. It's well known that about half of the recoverable reserves are produced within the first 18 months you complete a well. So probably 2/3 of onshore oil shale production today comes from wells that were completed only in the last 3 years. So therefore, the implosion of new wells being connected means that there's an accelerated decline in this oversupply. We'd observe an important trend, that is the dethroning of America's oil independence was already in process. That was due to the lack of sufficient economic returns on all that investment. And that's a long-term reality that doesn't change. COVID-19 solidified onshore oil shale's demise, we think. And then you see that in our investment positioning. As we've observed these trends and expressed it over the years, we've avoided onshore oil shale exposures. Instead, we've identified and invested in significant other portions of the oil complex.
Well, thank you for expressing a view that could be alarming for those that were not prepared for the comments you've just made. And I know you've spent a lot of time speaking about supply and the concerns there, but there's another side of the equation, which is demand. So perhaps expand upon that a bit.
That's right. We think the normal state of things is there's more people in the world, there's more affluence in the world, there's more movement in the world. With all those things, there's demand for more energy on a worldwide basis. So we think there's growing demand that returns and continues to grow. So that growing demand at some point is going to meet the shrinking supply, which continues to shrink. At that point, that's when oil prices will reset, well, even if the timing is uncertain. Now, bear in mind that once those two lines do inflect, restarting supply is not like going to your sink and turning on the faucet. And in the end, the longer it takes for the demand to come back to meet that supply means that more supply taking out of the system. Therefore, the starker the undersupply is when demand finally does return. We think there's a good probability that after that large an undersupply, that prices will not only come back to, but snap beyond where they were pre-current events.
Well, thank you. And I know we've talked a lot about oil, but oil's not the only, I guess, segment within the energy complex. So when you think about oil and gas, are there aspects to the energy industry that we should be thinking about other than oil?
Absolutely. So oil grabs all the headlines, but natural gas is a very large and growing component of the world's energy mix, for sure. For example, U.S. onshore production is probably approaching 100 billion cubic feet a day. That's the equivalent of about 14 million barrels of oil, which is more than the U.S. produces in oil. And while the U.S. is not oil independent in our view, the U.S. absolutely has a long-term overabundance of natural gas. Part of the reason for that is that there is difficulty in transporting natural gas across oceans. Therefore, that means that abundance ensures North America has an energy cost advantage for the foreseeable future. Though you've seen it, and you've also seen a dramatic shift in America in power production from coal to natural gas. The growing portion of power is one of the increased usage, but there are many others that continue to give a tailwind to natural gas demand, which we think is in no risk of dissipating anytime soon. Another attribute and consideration is that renewables definitely are and will continue to be a growing portion of the power production mix here in North America. Natural gas, we think, is extremely complementary because you need power sources that when the sun doesn't shine and the wind doesn't blow are dependable and can come online. We would observe, of course, that the energy mix has been beneficial in that displacing coal production with natural gas production is definitely less harmful to the environment. You've seen that America's CO2 output actually has declined over the last decade, in large part due to the shift in power generation. So the importance of these facts are that natural gas, including a substitution for coal, that is a growing portion of the world's energy mix, and that it will mitigate any risks of a headwind from oil consumption, at least for the next decade. Remember what we're saying here: more natural gas development is more economic activity for oil and gas companies.
Well, thank you. That definitely helped elaborate on that. To pivot a little bit, with all the noise from the media, it's hard to differentiate the short-term communications from what's really going to happen over the long term. So how can we think about the long-term implications for the sector and its viability, and how many energy companies are going to go bankrupt and ultimately fail versus the others that will consolidate and otherwise succeed?
Yeah, we definitely think that's part of the investor's dilemma, right? That the aggregate oil and gas business is a minefield, right? Because most of the U.S. public companies are focused really on North American production. And the way capital has been directed the last few years, those companies have been focused on developing new sources of oil production, right? And that's what we think is the most troubled part of the equation for the foreseeable future. And so with COVID-19, we really think there's a knockout punch. And also because these companies had business models that are now under significant contraction and restructuring. And the fact of the matter is, since the industry wasn't generating cash returns, it really financed all this drilling by raising capital through the issuance of debt and equity. And so the balance sheets of a lot of these companies today are troubled. So that's what you have a combination. You have a combination of troubled business model, and you have a lack of access to capital. As a result, many of the equities are impaired and some impaired fully.
Well, I mean, I have to say that outlook sounds to me to be pretty dismal, but perhaps I'm wrong. If there's a silver lining here, maybe it's an offshore or elsewhere. Where can one look?
Yeah, we think it's not all bad news. In fact, we think there's a number of well-capitalized companies with significant runways for growth, opportunities for consolidation, which they've already participated in, and they have sound business models, and they're being traded for pennies on a dollar. For example, Lindsay, we think there's an opportunity, as you said, in the development of offshore fields. So first off, that industry was left for dead with all the hoopla over onshore oil shale. That's where all the capital went. But in the meantime, the offshore segment has really remade itself. And so why do we see it differently than others? What are we looking at? So the timeline to develop an offshore discovery is regularly 10 years or more. And what happened was there were cost overruns that were significant in 2012 to 2014. So many projects for discoveries that were made never advanced. Of course, since then, weaknesses in oil prices have further delayed any of those projects being sanctioned. Therefore, we think there's a very large inventory of projects that are advanced stages of development. Okay, the next imperative, of course, is that inventory needs to be economic to develop. We recognize that. We believe that is clearly the case. And why do we think that? And that really is, it has to go back to this cost issue, all about the cost to develop these fields, right? We've continually pointed out that the fall off in offshore activity actually started at the beginning of 2014, 10 months before oil prices broke. So why was that? That was because the cost for developing these fields had increased to the point where even at $100 oil, they did not make economic sense. Today is a very different world, though. The cost side of the equation is radically different. So two things. One, it's obvious that each and every cash cost associated with developing these fields has come down dramatically. So therefore, the aggregate cost of developing these fields is a fraction of what it was. But more importantly and sustainably is, how do you develop a field? How do you engineer that process? How do you install the equipment? So there's many different processes in work today that the efficiency of which have radically reduced the economics of these offshore fields, to the point where we actually think that they're the marginal low-cost producer of an incremental barrel of oil. And we think over the last 2 years you had seen that. So leading up before COVID, the activity levels definitely were picking up, and there were many more projects that were ready to advance before the advent of COVID-19. The drivers that made those fields economic stay in place today. If anything, costs continue to come down and efficiencies continue to improve. But even though we say the offshore industry is interesting, you still have to be cautious. There are winners and losers, and there are segments of the market and there are companies that are winners and losers. The important thing is the financial viability of the business. You have to be there to be able to capture these opportunities in the downturn when the business does return.
Well, thank you, Bob. But, to play devil's advocate, some might argue, isn't all of this predicated on the price of oil? I mean, how are you confident prices will go up to a level that puts offshore production back in the money?
So as they say, our 40 years means we've seen this movie before. We've been through market cycles and crises, and therefore, starting there, as we said, back in 1973, since that time, there have been 15 times in a matter of months, the price of oil has either been cut in half or more, or doubled or more. So radical changes in short periods of time. 80% of the time, ups are followed by downs, or downs are followed by ups. Therefore, we think the opportunity today on the down slope. Further, as I explained earlier, the likelihood is the looming undersupply, the longer it stays that way, the more underinvestment, and therefore the beneficial return of supply and demand. So as I say, 40 years, we've seen this movie before. And all of that is because of, it doesn't work in a vacuum. It's low prices pull capital away, high prices bring capital in, bringing capital in oversupplies the market, taking it away undersupplies the market, time and again.
Well, thank you for speaking from your experience. And it's so often, however, that your views run counter to Wall Street, quote unquote, wisdom. And you're happy to express those views on panels and in interviews alike. So I guess a logical question is, what is our edge? What differentiates us?
So first off, over my 40 years of investing in the oil patch, right, it's frequently the place to be is at odds with Wall Street wisdom, right? Wall Street wisdom itself being an oxymoronic statement probably at its core. And remember, Wall Street's wisdom, whether those are the bankers or whether those are the analysts, probably been in this business for 10, 15 years, haven't been in it for 40 years, don't have the length of time and the understanding of cycles in these markets, right? So, and remember, much of the fact of why that happens is Wall Street wisdom drives capital, right? And anything that's worth raising capital for is worth raising more capital for and over raising capital for. That also means that anything that, even if it started out as a good idea, is going to be overinvested in. And cyclical businesses that are overinvested in drain the economics out of those pieces. So we do our own research. We invest where the facts take us. So it's not just 40 years of investment experience that we're speaking from. It's also all of those relationships with the managements that we've met, sitting across from them, and they're sitting front row, appraising and allocating capital. In addition, now I've been sitting in the boardroom of oil and gas companies for the last 15 years. So I've actually had a front row seat to shifts in the industry real time. I see where capital is flowing to, where it's coming out of, what has worked and what doesn't work. So we're not just investors, but we're participants in an industry with firsthand experience on how those dynamics are moving. That's critical, we think.
Great. Well, thank you. That leads nicely into our final question, which is please expand more on the opportunities that you spoke about. I know that an edge of ours, given our tenure in this space, has been our ability to speak to companies' managements quickly and effectively, which has been especially evident in this COVID environment. But what ensues? What endures? What are the opportunities that you see?
Yeah. So we would point out, as we said earlier, that most companies in the energy space are not a good place to put your capital today. That said, energy has been sold wholesale, and therefore that means even the good companies have significantly had capital outflows and repricing to them. So we think that it's extremely important to be a stock picker here. That's what really matters. Putting capital into the segment generally is not nearly as effective, we think, as finding and allocating capital to the winners. So that's what we've done today. We have companies in our portfolio which have all the key ingredients. They have a differentiated business model, possess barriers to entry that therefore foster economics that generate cash returns even in difficult times in the cycle. That leads to stronger financial results and balance sheets, and which means the capability and the experience to capture opportunities for growth, including consolidation and acquisition at weak points in the cycle. Frequently, that's because there's an owner-operator involved and aligned with us as investors, as we are in our investments aligned. So the 40 years of investing, we're positioned to continue to find these opportunities. So today in a COVID-19 world, we believe that volatile prices, declining prices, and substantially reduced prices provides a once-in-a-generation entry point, and we know how to navigate that landscape. That's why we'd love to have you come invest alongside with us. Thanks, Lindsay.
Well, thank you, Bob, for sharing your insights. Given your experience, you truly offer a perspective that is clarifying in such a confusing time, as I'm sure we can all relate to. In summary, it sounds like there are opportunities out there, but importantly, finding those opportunities is not easy. You made that evidently clear today. So, well, to everybody watching or listening, we welcome your comments and questions. So please reach out to us at ir@robotti.com or through social media, our blog, LinkedIn, and Twitter, which we regularly update, especially during this crisis environment. And finally, and importantly, we wish for you and your families continued health. And we hope and look forward to the day when we can meet again with you in person. So until that time, please be well and please stay tuned as we continue to keep you updated. Take care.